you could be using the proceeds in your exchange account to do this. So we take $300,000 of it to purchase the property, but it's not in your name, remember? And then you would take the other $200,000 and you would improve the property. Now, what's that property worth?
Wow.
$500,000.
Wow.
So you can complete your 1031 exchange, take title of that property, and it's all been done with 1031 money. Yeah,
Wow.
Wow's right, huh?
That I've never heard that process either. Welcome, everyone, to the Casandra Properties podcast, an episode today that we think is going to really deliver a significant amount of value. We're going to be talking 1031 exchanges by one of the best in the biz. We have Dave Foster, who's the founder of the 1031 Investor. He's a self-proclaimed deal junkie. And we had a little back and forth banter going before the podcast. So I think we're going to have a little fun today. Dave, how we doing?
Hey, it's awesome to be here, James. And it's awesome to be warm. How are you doing?
Well, it's it's awesome to be here, and it's not so. He opened up the opening volley was, "What is that you're wearing? A vest? I don't wear a vest." He's down in St. Petersburg, Florida, and I'm up here freezing my butt off in Staten Island, New York. So, I've actually spent a bit of time down in Florida. I was on the East Coast, and I did some investing in North Palm Beach and Singer Island. Excuse me, Singer Island.
Oh, yeah.
What's the market like down there today?
In Florida, like everywhere else in the country, is booming. It's all just booming is a relative term, though. What is someone's entry point for mom and pop real estate is another person's palace.
Yep.
And so it's really interesting. And actually, a lot of our work with 1031s these days is transitioning investors from these highly appreciated areas, your neck of the woods, California, where there's no cash flow available for people that want to own rental real estate and cash flow it. But there's these necks of the woods where you can still find things that will cash flow. If you ask anybody from Florida, everything's overpriced.
Right.
If you ask someone from California, they think Florida is the cheapest thing in the neighborhood.
Right. So this would be a good place for us to jump off. From what I understand, you moved your family from Denver to Tampa using the Section 121 Homestead Exemption. And there's a lot of folks picking up and moving from state to state today. Can you speak to the audience about the 121 Homestead?
Yeah, exactly. So actually, that's kind of the other side of real estate. And we actually used both the 1031 and the 121. So the 121 is for the house that you live in. Mm-hmm. When you buy a piece of property, move into it with your family and live there so that when you sell it, you've lived in it for 2 out of the last 5 years. Then as a married couple, you would get to take the first $500,000 in profit tax-free. And you get to do that once every 2 years. So when NAR tells us, the National Association of Realtors, tells us that the average person stays in a house 5 to 8 years, that means that 8 or 9 times in your life, you have the opportunity to sell an asset and take a bunch of money tax-free.
Now
that investment going.
Now that $500,000 exemption, if it's your primary residence, is wonderful. But beyond that $500,000 exemption over your basis in profit, you're not eligible for 1031, correct?
That is absolutely correct. Hence, the other shoe that's about to drop. The 1031 exchange exists for investment real estate. And with the 1031, you can sell investment real estate that's highly appreciated or that you've depreciated a lot on your taxes, buy new investment real estate, and you get to indefinitely defer the payment on the tax. Now, James, we talked about dancing girls at the beginning of the show. You better have them in reserve, because if I go to my next statement with you, it's going to be all over the ice. The cream is off the milk, and we're going to have to shut it down because no one's going to listen. But there is a way to combine Section 121 and 1031. If you have more than a $500,000 profit, let's say you got $1 million in profit, You could sell that and you could take your first 500,000 tax-free. Okay, nice, but no big deal, Dave. I want to eliminate the other 500,000. So what can I do? First step, move out of that property. Go buy your next primary residence right now. Go rent a property. Go do a home exchange for a year, whatever. But turn that primary residence into investment property. And then a year later, you're going to sell it. Now, you're selling an investment property, aren't you? And that's what the law requires for 1031 treatment. So you're going to do a 1031 exchange, but you're going to take $500,000 in what we would call boot. Normally, boot is taxable. But wait, did you also live in that property for 2 out of the previous 5 years? Absolutely, you did. So the first $500,000 is tax-free. The rest of it goes into your 1031 exchange to go buy new real estate, and you've effectively deferred or eliminated $1 million in gain in tax.
All right. So I've been doing this for 25 years, and that is the first time, and I've spoken to a litany of 1031 experts, and some of the best, self-proclaimed best, I guess. You're telling me that if someone is in the primary residence for 2 of the 5 years, which I knew, then they're going to sell the property. Before they sell the property, they move out. Okay. For a year, they rent the house to whoever it may be. What is the threshold that the IRS is going to look at and say, arm's length transaction? Can I lease it to my brother? Can I lease it to my son? Does it have to be to a third party? Does it have to be arm's length in order to qualify?
It doesn't have to be arm's length by meaning you can work with related parties. It needs to be a business-like transaction. So, but that's the easiest part of the puzzle. You rent it to your brother at market rate.
Mhm.
Sign a lease, collect the rents, declare the rents, pay the tax on the rents, take the depreciation, offset the rents. And then at the end of the year, if your brother's been nice to you and you got a good Christmas present, you can gift him back the rent that he paid using the annual exemptions. So it's all perfectly legal using different parts of the code to have someone in there you trust, have it be a situation where you're treating it as investment. So that satisfies the 1031 side.
All right. So I want to slow this down for a minute and rehash this, because this is something that's affecting a lot of our listeners.
It's
That
a big deal in your neck of the woods. It's a big deal.
It's a real big deal, folks. So basically what we're saying is, if you're contemplating making a move and you're looking in Jersey, Florida, the Carolinas, all the different places that it seems people are heading to now from New York, and you've owned your primary residence for 2 of the last 5 years, 1 year before, at least 1 year before you're going to effectuate the sale, you can lease the property to a family member, to a tenant, whomever it is that you want to lease it to. For 12 months, you collect your rent. At the end of the 12 months, if it was a relative and they took care of the house the way you had hoped that they would take care of the house, you can gift a portion or all, depending on the numbers of that, back to the family member tax-free, and thereby be eligible for taking your $500,000 exemption under the Section 121 Homestead and 1031 anything above that $500,000 when you go to sell and you want to trade it into a new parcel. I get that right?
That's exactly right. And I feel like the Romco commercial guy now, but wait, there's more. Are you ready for the other side of things?
I am.
Okay, so what you're doing when you do that is you are converting your primary residence into an investment property. Okay. The rules for primary residence are that you must to have used it for primary in the past for the 2 years. The rules for the 1031 side, the investment side, are that it is currently being used for investment. So Just like you can convert a property from your primary into investment, what if you then sold it, did the 1031 exchange, and purchased a property, one of the places you were saying, Tennessee in the Smoky Mountains, where it's time to retire to. And you're doing a 1031 exchange. So the property that you sell is being used for investment. The property that you buy, you're going to use for investment for a year or so. And then after that is over, maybe the lease is up where you've been for a couple of years. So you move into the former investment property and convert it to your primary residence.
Now,
The change of use doesn't create a taxable event.
once we buy this beautiful getaway in the Smoky Mountains and we're going to Airbnb it, or we're going to rent it out.
Yep.
We're not quite ready to retire yet, but we want to use the two sheltered gains to acquire this piece in the Smoky Mountains. How long do I have to use it for investment purposes to be clean?
There's no statutory holding period. There is a safe harbor from the IRS at 2 years.
Okay.
So that feels good. But there are a lot of folks in the industry, I talk to CPAs every week, who feel comfortable at anything more than a year, because anything more than a year is 2 tax years.
Okay. So again, folks, what we're talking about is selling the home, your primary, you're done here, you're going to relocate. We're taking the $500,000 exemption again under the 121 homestead exemption. Anything over the $500,000, we're going to tax exchange into a new property. You want to buy your home, your next home, but you want to preserve your tax-free exchange rights. We can do this if we take those monies, we buy our dream home up in the Smoky Mountains, as long as we don't move into it immediately, and we treat it as a business transaction for at least 12 months, 2 years is safe harbor, but at least we get past the 12-month mark, we get into a second tax year. Now we can say, you know what, we're done with the Airbnb business, or we don't want to rent it again to somebody else. You can now move in and your gain is sheltered, and there's nothing retroactive they can do for that transaction, correct?
That's it. You want to hear the true story of someone who used it?
That's amazing.
It's mine.
It's amazing.
I started in Denver in 1996, and I bought a duplex and fixed it up and sold it, and then realized I had a silent partner named Uncle Sam.
Yeah.
Which really ticked me off.
Yep.
So that's when, as an accountant, I pieced together the 1031 tax laws that it just changed. Is that that's it, that's mine. What we started doing was acquiring rental properties in Denver, and periodically we would turn one of them into our primary residence. We would sell the primary residence we were in, take the gain tax-free, move into the investment. We wanted to buy a sailboat, James. Now, I know I'm from Kansas. My wife's from Minnesota. We're living in Denver. There ain't a lot of sailboat water there. But for some reason, we wanted to sail. So we started to position, using the 1031 exchange, our Colorado properties into Connecticut, Fairfield County. And then in a couple of years, we were ready to move to Connecticut to get the sailboat water. So we moved to Connecticut. Our portfolio awaited us. One of them was a really nice property we moved into. And we started the exact same process. We would then convert it into our primary residence. Then a couple years down the road, take the gain tax-free. Move into another investment property, convert it into our primary residence. It didn't take us long, James. You're hearing a common theme here. Before we realized that although we wanted sailboat water, we forgot to ask for warm sailboat water. So Florida beckoned. So we did the exact same thing. We started to position our investment portfolio in Florida ahead of our move, so that when we were ready to move, we had houses in Florida. We moved right into one, converted it into our primary residence, turned the gain into tax-free, and literally to the week of a 10-year goal that we set in 1996, we moved on board and cast off the dock lines of a 53-foot sailboat paid for with tax-free real estate dollars that we had been banking from the sales of our primary residences.
Now, I became a fan of yours, and we're going to deviate a little bit from the 1031 stuff, and folks, we'll get back to it. Believe me, there's a hell of a lot more value coming, but I did want to talk a little bit. I heard you talk about this on another podcast. You lived on this boat for 10 years, I think, with your boys. Is that correct?
Yeah. We raised our 4 boys on it. Crazy times. I'd do it again in a heartbeat.
Man, that had to be some experience for you.
It was, people always, they nickel those things around, whether it's in the mountains in a cabin or on a sailboat, an island overseas, whatever. Those opportunities come around, and if you grasp them, you're changed forever. My older boys still think of themselves as boat boys.
That's amazing.
They look for the day when they can get their own boat.
That is absolutely amazing. We get so stuck in the rat race, if you will. And, speaking of which, I think that is the difference with this market here. We talked a little bit before we came on the air that this time it's different. 2008, 2001, after 9/11, our challenges are very different than what they are today. So we're in a situation now where they closed things down for so long in New York that we've broken our habits, and we've replaced those habits now with new habits, right? So we've all had that time on a vacation where you get to day 6 or 7 and you're starting to think, gosh, there's a better way to do this, or, maybe there is another way to live. And then boom, you come around to that 7th or 8th day and it's back in, and you're head down and you're working. Next thing you know, another year came off the calendar before you go on another vacation. And it seems I'm 45, I'll be 46 tomorrow. The last 20 years are a blur. And there are so many things that I swore that I wasn't going to do and I was going to do. And it just seems to go by so fast that you don't take time to grab a hold of that. And what this pause did, one of the silver linings from coronavirus, is that folks are doing that now. They're finding there is another way to work. We don't have to necessarily be in an office 5 days a week or 6 days or 7 days, right? We don't have to have the salary that we were grinding to secure, because we can decentralize and go to one of these tertiary markets where for 30% discount from what I was getting paid in New York, I'm living like a king, right? It's a totally different mindset. So,
and I've got a son who's going to be graduating in electrical engineering. And this is how the world has changed. They won't even interview him in person.
Wow.
So he's going, Dad, I'm going to be able to live wherever I want. So why not pick the beautiful spots where you can, like you said, live like a king, because you don't have to be tied to an office. That's the most beautiful thing in the world. I'm a little further along than you. I'm 62. And we were talking about doing a family vacation next week. Kind of feels like maybe things are going to be settled down enough. And we're crazy Floridians anyways. We do spring break. We don't care. But we were trying to think, where should we go? What should we do? And everything that's kept coming up on the list was things that we had already done.
Wow.
As just part of living.
Wow.
And it's like, wow, there's been a lot that we've packed in because we haven't been location bound. And that's the key difference in this real estate market, unlike any other, is you can be in New York and be generating income from Texas. And you can do it part-time, and you can actually work for a guy in New York, make rental income in Texas, and live in the Smoky Mountains.
The opportunities afforded to people today, I don't think folks are quite grasping the world that we live in right now. I was watching a video or a podcast with Elon Musk a few days ago or a few weeks ago. They all blur together. And the interviewer says to Elon Musk, so how do you go from being in this one market segment to building rockets? Like, it was a quantum leap. There's no connection. There's no synergies. How did you identify the opportunity? And then how did you become an expert? You're doing things with rockets that NASA hadn't done for the prior 40 years, you've done in a very short period of time.
Yeah.
You know what his answer was? YouTube.
Oh, I love it. Absolutely.
So the interviewer thinks he's joking, and he says, but how did you really learn? He said, no, YouTube. He said, you can go be an expert on anything you have available to you right now in this digital age, access to the best information directly from the best sources, in most cases for free. And if you're willing to put the time in, you can become an expert on anything. So here he is investing billions and billions of dollars, sending rockets up to Mars. It started with YouTube. Like, folks,
I believe it.
this is really a unique moment in time. And we're at such a unique place where we should be very cognizant of our ability to kind of shed those ties and shed those, boundaries that we've seemed to put on ourselves and shake those lids off that we've seemed to put on ourselves. You really can do anything now. It's a remarkable, remarkable time, Dave. And I applaud you for taking advantage of these things earlier in life. So I have to ask, growing up, was there an influence, or how did you end up in this mindset of real estate and moving and shaking and 1031s? How did that all come together for you?
Wow. That was the 1031 thing really was just a fortunate accident, because I happened to get stung with a tax bill right at the moment when the tax law changed.
Mm-hmm.
And because I had my accounting, it's like, oh yeah, I recognized the opportunity and I recognized the power because of the pain I went through. So that was, as far as a mindset, they talk about the flyover states, right?
Mm-hmm.
So, and generally there's kind of a mocking of them because there's not that many people. It's all just farmers and ranchers and stuff. But I got to tell you, growing up in Kansas on my own ranch, where we would load a gun on a horse and take off for days when you're 14, you start to learn a lot about what self-reliance is.
Oh, yeah.
And you start to look at problems, and instead of saying, ooh, that's a problem I need some help with, your first thought is, ooh, I need to fix that.
Yep.
That's a paradigm mind shift that we want to be careful we don't lose, because you're right. The assets and the opportunities to fix anything and learn anything are there. But we've got to make sure that we don't become people who simply want others to solve it for us.
So I've never shared this on air before, but it's a perfect segue, so I'm going to. Growing up in New York and in the city, I was never an outdoors person. There was no connection for me to Mother Earth outside of, what you read in textbooks and the occasional excursion with the family, right? Short of that, I just wasn't an outdoorsman. And I had done a deal for a colleague and a friend who now has become a business partner years later, and great deal, made him some good money. And he had said, James, as a bonus, I'm going to take you away on a hunting trip. And I'm going to myself, can't you write a check? You're going to take me on a hunting trip? Like, I don't want to hunt. Like, I was one of those guys I didn't know it. So I had completely discounted it. I thought it was offensive, all of those things that you read. And look, everyone's entitled to their opinions, and I don't judge anyone for them, but I didn't know. I hadn't been exposed to it. So I go on this trip, and it was a turkey hunt. They bring me out in the woods at 3:00 in the morning. The guide positions you, and I'm sitting there thinking, what the hell am I doing in the woods? I'm, sitting on the ground. The guide disappears. Dave, when I tell you, they call it when the lights come on. When the sun came up, it was a biblical, life-altering moment for me. The birds start chirping, the turkeys are hammering, the deer are up on their feet. It was almost like this primordial connection came over me. I fell so in love with it that I ended up becoming an avid outdoorsman. I have a farm now, 200 acres up in Pennsylvania, where it's not get on a horse and disappear for a week and that kind of freedom, but being able to get centered again and connect with the earth and to plant the crops and then harvest the crops and feed the cows and then milk the cows. It just, the whole thing, the way it ties into each other, it is remarkable. So those flyover states offer some of the most absolutely amazing ways of life. And I think that the country is starting to wake up to that. So I got a little bit off track there.
That's
I wanted
awesome,
to
though.
share that though.
Well, you know what? To bring us back on track, though, that's one of the most gratifying things of what I do, because I help people just like you from the cities of New York, from Silicon Valley, because there's so much of what you're talking about that's available to them now using the 1031 process and becoming landlords long distance and positioning your real estate correctly. They can go live in that RV in Moab and enjoy mountain biking. We have opportunities that we're just now starting to comprehend
So
because of what COVID's done for us, crazily enough.
it is crazy how these things come together. So I want to share some of your knowledge with the audience. By the way, Dave has got a killer LinkedIn page. He's got like 80 articles, really well thought out, beautiful page, a lot of information. So if you have a chance, check that out. And he's also got, I think I saw 30 plus videos on your YouTube page.
Yeah, we've done a bunch. We broke them down into small little sections.
Really informative
Me,
stuff,
yeah.
folks. Anything that you missed today, certainly reach out to Dave or check his pages out. But let's go back and explain to folks now, what is a 1031 exchange? You know, you can't just sell a piece of property, put the money in your bank account, and then go buy a property, right? You need a qualified intermediary or a QI involved. Can we go back to the very basics?
Sure.
I'm just ready to sell my property. What do I do?
Sure. So the IRS has to let us do them because it's been part of the code for 100 years. They just don't have to make it easy. So there's hoops you have to go through. And the first and most important one you just mentioned. If you want to do a 1031 exchange and sell your investment property and buy new investment property without paying the tax, you have to use the services of an unrelated third party called the Qualified Intermediary. They're going to document the exchange on both closings, so they have to be involved before you close your sale. The sale is what starts the 1031. And every month I still get a call from someone that closed their property last week and they want to do a 1031. And I said, that's great. We'll do it on the next one. And it hurts.
Yep.
So, but the QI documents and handles the transition of the money because the IRS won't let you touch it either. So that's first and foremost. You've got 45 days only to find your next replacement property. So it's not something where you can throw the money in the bank and then just lollygag around. You got to be very focused with your search. You've got 180 days to close. That's not such a big deal. The 45 is a killer because at the end of day 45, you can't change your list anymore. You're always going to be looking to spend at least as much as you sold, or to purchase at least as much as you sold if you want to defer all tax. But what that leads into, James, is some crazy fun strategies to position yourselves where you can get the best income. So you sell a Brooklyn brownstone, 2.4 million. What are you going to find in Topeka, Kansas to buy for that? Well, maybe you could find 10 $240,000 properties. The number of properties doesn't matter. It's the valuation. So you can sell one and buy several. Or for those folks that are invested maybe upstate New York and where prices are smaller, but they're looking to get into multifamily or commercial investing, sell $500,000 properties and use the proceeds to 1031 into a small apartment complex.
All right, let me pause you there because there's a lot of questions that I want to ask for the benefit of the audience. These are things I've learned over the years, and it's not what you would think on the surface. So first thing, folks, is in New York, we use attorneys for everything, right? The attorney that's handling your closing is not necessarily a qualified intermediary. There are specific QIs that you need to work with that will preserve your exchange. Don't think just because if you close and the money goes into your attorney's escrow account that you're covered. That is not the case, correct?
Now, they're actually prohibited by law. because they have a relation to you. They're doing your closing.
Okay.
They have to be totally unrelated in all ways
Okay.
to you by family and business.
Now, does it have to be a QI from your state, or can it be a QI from anywhere?
No, since 1031 is a federal statute, it can be a QI anywhere. It's all going to be processed exactly the same.
Okay. Now, we go ahead and we're setting this up. We contact Dave. Dave acts as our QI. The transaction closes, and I want to take, I have a $500,000 gain, and I want to take $100,000 because I want to, go on a trip around the world, and I want to save the other 400. Can I do that, or does all the money have to go into the account?
That's another beautiful strategy. It's what we'd call a partial exchange or the spouse pleaser, because you could take that 100,000 and you're going to pay tax on that, but you'll still shelter the remaining 400,000 of gain. So what an opportunity to periodically spin off a little bit to live on, to have fun with, whatever. So many people get into this mode. We got a lot of fix and flippers, right?
Yeah.
So fixing and flipping doesn't qualify for 1031 treatment because your intent is not to hold the property. Your intent is to resell it. But people want to do that as a job to make money. Well, why not slow that down a little bit? And instead of buying, fixing, flipping, buy it, fix it, rent it, and then either refinance it, which is tax-free, and use that money to live on, or wait for a while and then sell it. And when you sell it, carve off a little bit to live on and put the rest into 1031. It's never an all or nothing proposition. My wife, actually, I've got to give her credit. She came up with this the other day. She goes, Dave, why would you want to fix a new property and then put a renter in it? Why don't you buy it, rent it for a while, kick the renter out, fix it, and then do the 1031 with a fresh, clean property? It's brilliant.
So now, are you able to use any of the exchange dollars in a rehab, or can the exchange dollars only be used toward the acquisition?
Hear that sound? We just jumped into the deep end of the pool. So there is a way to do it. So the premise is that you cannot exchange for improvements on property you already own. So if you 1031 into a property that needs improvement,
Mhm.
once you take title to it, you can't include the improvements. But there is a thing called a reverse improvement exchange, where we as the QI take title to that new property, whether it's a property that needs improvement or whether it's a lot that you're going to build on. We take title to it, but you control it. And then you would improve that property while we own it. You also make all the income off of it as well. It's totally yours, except for in name. And then as soon as those improvements are made, then you take title to finish your 1031 exchange.
And that would have to be done within that 180-day period?
Correct. So let's say you had a $500,000 property you own for cash. We'll take debt out of the equation for a minute. You found a really nice $300,000 property that needed $200,000 in work. Well, you could do your 1031 and you could buy it. You're buying down 200,000, so you're going to pay tax on that unless you buy another property. But if you do a reverse improvement exchange, we would take title to the property. And if your other property had sold, you could be using the proceeds in your exchange account to do this. So we take 300,000 of it to purchase the property, but it's not in your name, remember? Then you would take the other 200,000 and you would improve the property. Now, what's that property worth?
Wow.
500,000.
Wow.
So you can complete your 1031 exchange, take title to that property, and it's all been done with 1031 money. Yeah,
Wow.
wow's right, huh?
That I've never heard that process either. So you actually could, if you didn't have additional capital available, use the proceeds from the transaction. The transaction is closed in your name. The balance of the money is used to make the repair. Then you acquire the asset. And if you are less than, like you had said, if it was a $500,000 gain and it was a $300,000 acquisition, 200,000 in improvements, now you're taking title at $500,000, you're clean.
That's exactly right.
That is brilliant, man. That is absolutely brilliant. Okay, so I want to go forward with an exchange. I'm going to call you up. I need to identify properties. What is the process of identifying within that 45-day prescribed time period?
Right. So there's certain requirements on that list. First of all, it has to be in place prior to midnight on day 45. But what it is simply a written instrument between parties to the transaction. Now, almost 99% of us QIs are very anal about the fiduciary responsibility. So we have a form for you where we require that it come to us. But technically speaking, if you put a contract in on a property during the 45-day period, that's an instrument in writing that counts.
Okay.
So it just has to be in writing. It has to be a specific identification. Remember phone books? The Staten Island phone book would not count as your identification list.
I was just going to ask, how many can I send you, Dave?
Yeah. So in general, if you're trying to buy at least as much as you sell in an individual property, you're going to keep your list to 3 or fewer. There are some times when 5 or 6 might work, but there's extra rules that we don't need to bog everybody down on. We've got a couple of videos on the YouTube channel that explain it real easy. But in generally, 3 to 6 properties is where you're going to be limited to.
Okay, so we've identified these properties. We're proceeding with a contract. We're now, let's say, in day 70 or 80 of our 180. We do inspections and we find out the foundation was undermined or there's a cloud on title. Let's say something that was completely out of our control is an heir to an estate from 2 decades ago, and they're unable to convey marketable title. Now what? Is my exchange blown?
Well, at that point in time, if you're past your 45, so you cannot change that list at all anymore. If you have other properties, you can still access them.
So I can go
that are
back
on your list.
Okay, so we can go back to the list, and if this one deal blew up, we can preserve the exchange so long as it's proceeding with a previously identified list prior to the 45 days.
That is correct. Here's the challenge with that, though. By the time you've gone 70 days in a seller's market, the odds of those other properties still being available, pretty slim.
Yeah.
So you've really got to be so focused during the 45. As a matter of fact, one tip is that, well, 2 tips. First one, try to get contingencies, go into contract before you close the sale of your old property. Try to get contingencies from the seller. Now, everybody wants to say, Dave, they won't do that. Nobody will do that. It's a seller's market. Nobody's going to take contingencies. Okay. What was it? Somebody once said, you're going to miss 100% of the shots you never take.
Wayne Gretzky.
Was that it, Wayne? Awesome. Yeah. So, okay. But what does it hurt to ask? But here's what you cannot forget is that in the 1031, you're not just a buyer, you're also a seller.
Yep.
So what if you sold your property contingent upon finding the perfect new property? See, contingencies work both ways. You could do that.
Can I introduce option money if I wanted to go to the new person I'm purchasing from? First of all, so when I go to this new person, do I need to source the deposit from my QI?
Can come from anywhere.
Can come from anywhere. Okay.
So your exchange doesn't have to have started. You can go into contract before your old property closes.
So then I can throw option money at people, and by that, folks, I mean, hey, look, I'm in good faith. I'm proceeding with an exchange. I'm going to be selling my property. It's going into contract. I'd like to purchase this property, but I need to effectuate that closing first. I need 90 days. I see your taxes are $2,000 a month. Your mortgage is $2,000 a month, whatever it may be. Here's 20 grand. It's an option. I've got the option to convert this within the next 2 or 3 months. If I don't, you keep that money. I can do that out of my own proceeds. I don't have to touch the account.
You can. Can I make it sweeter for you and you split the difference with me?
Yeah.
All right. Instead of making it an option, go into contract and make it releasable earnest money.
Okay.
So they get the cash,
Yep.
and that's fine, but it comes off the top of the purchase price. Whereas the option just buys you the right. Releasable earnest money says, hey, that $10,000 turns a $500,000 purchase into $490,000, but you get the cash right now.
I love it. I love it.
Either way works though. Oh, and by the way, when you use your own earnest money like that, at the purchase, you can actually get that back. You would put a line on the settlement statement called return of earnest money, and that money comes back to you. And then we send in additional funds from the sale so that only the 1031 proceeds go forward in the purchase.
Okay. So let's say that we've sold, we've identified, we don't have any bumps in the road. We're moving forward. There's language in the tax code. I believe it's like kind exchange, correct? Okay. Can you define for the audience what does like kind exchange mean, and give a couple of brief examples of what would pass the sniff test and what would not?
It's beautiful. Any type of real estate that produces income or used to produce income or held for appreciation. In other words, like kind, I could sell land and buy residential. I could sell single family and buy commercial. I could sell industrial and I could buy an apartment complex, as long as it is being used for investment. I was having a conversation with a client in South Carolina just this morning. Her client is selling a quadplex and buying 5 boat lifts, boat slips.
Boats?
Yes, there is an industry around Charlotte where there are boat slips, and these boat slips have been deeded. So you don't get a registration certificate every year. You get a property tax bill.
Wow.
That boat slip is real estate. So she's going to buy 4 holes in the water that she's going to generate rent off of.
Wow.
That's how loose real estate is.
And the threshold, I guess, is that there's a title or something that comes with it, and it produces.
Yeah, or that it's actually whatever each state considers to be real estate. For instance, all 50 states consider oil and mineral gas rights to be the same as real estate. So you could sell a brownstone and go buy some royalties in a few Texas oil wells using the 1031 exchange.
Wow.
Crazy, right?
Absolutely. I have to tell you again, 25 years doing this. I've been a part of many, many, many exchanges, and a lot of this is new to me, Dave. This is absolutely fascinating. So we're proceeding with our transaction. Am I allowed to use any of my qualified money toward closing costs?
Yes. Now, what those closing costs are, we are not given a bright line because there could be so many different things.
Mm-hmm.
But in general, the standard is going to be whatever is used to actually close the purchase of the property, as opposed to prorations or prepaids like rent and that kind of thing, or costs of finance. So generally, your origination costs for a loan are distinguished from the actual real estate itself.
Points on the mortgage, all that stuff.
Right. But your attorney fees, general things, it's really up to what you and your accountant decide. An appraisal fee, if it's put on the settlement statement, could easily be construed to be a cost of the purchase because it can't happen without it. It's just kind of you and your accountant sit down with a laundry list. And if you're bigger than they are, you'll probably win every argument.
All right. So we've gotten through our first exchange. We're now in our new property. We're in a great market. We bought it, at a steep discount, whatever the conditions are. And we get a knock on the door and we get a tremendous offer. Is there a seasoning period? How long do we have to hold it before we can effectuate our next exchange?
Oh, that's a great question. You teed it up so well because the standard is not a time. The standard is your intent.
Mm-hmm.
So when that person knocked on your door Were you trying to sell the property? I don't think so. Was it listed for sale? I don't think so. Did you have a renter in it with a lease? Yep. So what was your intent? It was to hold, and along came someone with what was it? The Godfather's Pizza, the offer you can't refuse, right? And so you sold it, although your intent was not to sell.
Okay.
So absolutely, that's perfectly. So again, most people feel comfortable at anything more than a year, but there can always be circumstances. For instance, my favorite client of 2020 called me a month after he purchased a property and said, I want to sell this. I'm going to make a lot of money. I went to a 1031. I said, no, you're not, because you can't buy things just to flip them. He said, but you don't understand. I agreed to honor the long-term lease of the tenant in my sales contract. That's the only reason the guy sold it to me for a discount, because it was a friend of the seller. I said, well, okay, that's cool, but here you are selling it. So again, that doesn't look like good intent. He goes, oh, I see what you mean. Well, it was the bear. What? A bear had taken up residence at the trash can of the house in Tennessee. The tenant was so scared she couldn't take the trash out, so she broke the lease and left. The guy said, Dave, my accountant and I both do not want to argue with a bear. Does the IRS? I said, no, probably not.
Okay. So, folks, just to be clear here, it's not that you can't at any point go and hire a realtor and put the house on the market, or the building or the asset or whatever it is on the market and sell it. It's just during those first 12 months where you can't do that. The intent has to be, you bought this asset, you were planning to rent it and keep it and have it generate money. You were going to monetize this long term. Along came this amazing offer. That's where you can do it underneath. Right. Along came the bear. And inside that 12-month period, now you can go ahead and still safe harbor the money and effectuate an exchange. Okay. How many times can I do this, Dave?
Oh, this is beautiful. Allow me to introduce you to the 4Ds. You got a pen in your hand, so I know you're ready. Defer, 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 and die.
Like an idiot. Here I am writing it.
As long as you own your replacement property,
Mm-hmm.
you will never pay the tax. As long as any time you sell that property and do another 1031 exchange, you will never pay the tax. If you change the use by moving in, you will never pay the tax. And at the end of the road, if you die owning that last property, then under current law, your heirs will receive it at what is called a step up in basis,
Mm-hmm.
which means the tax goes away. So at the very beginning, I said you indefinitely defer tax. There's a way very easily to defer it until you die and then have it disappear for your heirs. And that's true legacy wealth.
So we work with a number of what they call family offices and just individual wealthy folks that have been rolling exchanges forward for, in some cases, literally decades. They've just exchanged into
Yes.
exchange into exchange into exchange. So as you're rolling these exchanges forward, you're each time that gain is growing, right? At some point, there's this tax liability that has to be mitigated at some point. Now, there's a lot of talk in the real estate community about the new administration and what's going to happen with the 1031 exchange. In some instances, it's one transaction. In some instances, we're working with clients, Dave, where literally it's 10, 15, 20 transactions that have rolled forward. Can you speak to us about what you're hearing and what do we think is going to change, not change? Is the 1031 here to stay? What would your advice be to those folks that now have, in some cases, generational gains that are out there and they're not sure what to do?
Right. Well, I guess the first thing I would say is that I'm a big fan of Gideon Tucker, who was an attorney back in the late 1800s, who coined the phrase, that made the statement that no one's person, property, possessions, or liberty is safe while Congress is in session. So we're always going to have this threat, whether the Congress is red or blue or purple polka dotted.
Yep.
They love tax dollars. So here's what's really interesting, though. Since I've been doing this now for over 20 years, I've been under 5 different presidents, a bunch of different administrations, both Democrat and Republican, every conceivable configuration of Senate and House. Every one of them has talked about getting rid of the 1031 exchange. Every one of them.
Mhm.
Do you know who the only one who actually did it was?
No.
The one you would think the absolute least. President Trump in 2018 eliminated the personal property sections in 1031. You used to be able to exchange, get this, jet airplanes. And he eliminated that type of exchange. So he can no longer do a 1031 on his gold-plated 747.
So,
But think of it, of all the ones you'd expect, that's the least.
so that was eliminated from the 1031 program. I believe that those types of transactions are included, however, through the Jobs Act in the opportunity zones. Was it done to try and bolster the opportunity zones?
It could have, it very well could have been. The motivation, I'm a little foggy on, but yeah, you're right. But it was the first time in 100 years that 1031 had been monkeyed with.
So do you think that there's future monkeying on the horizon?
There could very well be, but I think that President Biden has a few more important things on his plate right now to worry about.
Yep.
And it seems like each day the honeymoon's getting closer and closer to being over. And so, I just can't bring myself to worry about it too awful much. For one reason, because he's so busy with other things, but for another reason, because when you dig down and look at all the data, 1031 is a massive economic generator.
Massive.
That single-handedly prevents a ton of inflation because it's making dollars work harder and faster. It's increasing velocity. If we stagnate the real estate industry, we stagnate dollars, and Congress has only one option, and that's print more.
Yep.
And that's when inflation occurs. So I'm really not too awful worried about it. I don't think that you should stop doing them because you're scared they're going to go away. As a matter of fact, I would think that while you've got the opportunity, you want to make those last few placements.
Right.
Because remember, it's a long time from the last defer to die. So you want to kind of hang on that. That's actually what concerns me the most, James, is the step up in basis going away.
Yep.
I see that as a big, big deal because you're right. That intergenerational wealth is huge. And I know he wants to do that. But again, like everything, over the course of decades, we've seen that come and go and come and go, and estates change value. So I can only act on what I know today. And I know it's a great opportunity today to defer tax.
No, it sure is. And it has been for a long time. There's some of the advice we've given to some of those clients that are in those situations are, as you said, while it's here, let's use it. If you have real concerns, particularly about the step up in basis in your estates, what we're doing is in the opportunity zones, you can take all of these, could be 1, 2, 10, 100 exchanges you've done. You've rolled forward a massive amount in basis. Through the opportunity zone, you can invest in an asset. There are pretty specific criterion about, well, first of all, it has to be in a QOZ. You make the investment, you invest the additional dollars in improving that asset. If you hold the asset for 10 years, it is 100% tax free. All of those gains of the past, you don't have to worry about it going to the estate. It is wiped clean. Now, where it goes beyond that, will have a various different treatments and different things you have to worry about. But there is an opportunity to roll these things forward and kind of clean the slate if you're so inclined to do it. So, okay, we're back in 1031 world. We've done a few clean transactions. I want to ask you about some not so clean transactions and see if it doesn't qualify. Do you know any neat ways to work around it? A few different areas. Number one, you talked about fix and flips. There's no intent to rent the property, so unless you take those steps, that's out. A lot of the work we do here, Dave, is centered around pre-development value. So we go in, we find an asset, we go into contract, and through approvals or through repositioning of tenants prior to closing, in many instances, we have now taken a piece of property that was $3 million and it's now worth $6 million. In many instances, we never even take title. We take money by assignment. The new person steps in, takes the entitlements, and they move forward. That is not a 1031able event, correct?
Au contraire, mon frere.
Really?
There may be a way. So you're one of the few markets in the country where things percolate long enough to make it work. Pre-development. Yeah, that was the magic word. You go into contract for a property to purchase it at 3. By the time you take title, it's worth 5.
Mm-hmm.
Before you take title, though, you've been under contract for more than a year. And if you have been under contract for more than a year, then in many cases, we've got to vet them, but in many cases, that contract itself becomes like kind to real estate. In other words, the bundle of rights that constitutes that contract is considered to be equivalent to the bundle of rights you would have if you owned the real estate itself. Just like a land lease in Hawaii. You don't own the land, but you can 1031 it because your lease is considered to be the same bundle of rights. So you would take your contract, and rather than taking title, you would assign that contract to the buyer.
Correct.
And you would do a 1031 exchange into $5 million of other investment property and defer the tax on all $2 million.
I have to go back here and make sure I've got this. Buy a piece of property for $3 million through approvals and various different ways. We're adding value. We now sign a contract for $5 million, subject to these approvals being concluded prior to the transaction. Fast forward 18 months, which is nothing in New York for getting approvals. That goes by, it seems like, in the blink of an eye. We're now 2 years into the transaction. Dave, you're in contract with me to buy this piece of property. Do I have to close on it and sell it to you?
No, that would change everything.
That would change everything for the worse.
Correct. Because if you take title to it and sell it to me the next day,
no intent.
Why did you take title?
Right.
Primarily to resell it.
Man, this is unbelievable. This is unbelievable. So contract assignments, in contract for at least a year, value add, appreciation, assign it. You would take that money as the intermediary, and now we can assign that. We can use that as an exchange moving forward.
Yeah.
What happens? I'm sorry, Dave. What happens if I have 4 partners and we're each pulling $1 million out, and my partners want to go do whatever it is they're going to do? I don't want to be a party to this entity anymore. I want to preserve my rights. How does that work?
Okay, well, you mentioned entity. So what is important is that the taxpayer that owns the old property has to be the same as the taxpayer that purchases the new property.
Okay.
Now, if that's just you yourself are selling, so you yourself would buy. If it's a tax-paying entity, like a multi-member LLC, the LLC has to sell, the LLC has to buy. So the 4 partners in that situation are kind of stuck together because the LLC is the taxpayer, not the individuals. So your options would be sell as the LLC, buy as the LLC, but only do a partial exchange. Keep enough cash out to pay off the partners and buy out their membership interest in the LLC.
Now, what if my membership in the LLC was through a wholly owned company that I only own?
Still the same thing,
Still the same.
because that entity doesn't own real estate. It owns a membership share in an entity that owns real estate. Now, another option would be, let's say you got 4 partners, and we've done this before. It's kind of fun. The LLC sells and starts at 1031, and then it goes and buys 4 different properties. It buys a ski cabin in Vermont. It buys a Florida beachfront. It buys a bunch of land in Colorado, and it buys a Texas mansion. I don't know. One for each of the members and where they want to go next. The LLC completes the exchange, and then immediately after that, the LLC dissolves and distributes the properties to each former member. The dissolution of an LLC is not generally a taxable event.
That is absolutely brilliant. Wow. Wow. Okay. So we've covered instances where we're essentially contract vendees. Can you talk a little bit about, we hear this term all the time, and I seem to get a different definition from each expert. What's a drop and swap?
That was one avenue of what I just told you about.
Okay.
Was to do the 1031. So that would be a swap. I'm doing the 1031, swapping properties, and then I drop the LLC and distribute the properties to the individuals. Now, for years, the IRS loved that direction. That was the preferred direction. Did them all the time. The opposite direction, though, is to dissolve the LLC first and distribute the property that's probably already under contract to the 4 members, so that now the 4 members are tenants in common. They each now own actual real estate.
Mhm.
So each one of them can sell their 25% and do their own 1031 exchange. Or 2 could combine, or 1 could do one, and 3 could take cash without affecting each other. That is what we would call the drop. You drop the LLC and then swap the properties after the fact. Now, there was a lot of hesitancy on this one for years for a couple of reasons. First of all, the IRS had issued some rulings that just weren't all that favorable. And then they got silent, so we didn't know. Secondly, though, we always go back to intent. If you dissolve the LLC and then the property is deeded from the LLC to you, and then you immediately sell it,
Mhm.
how long did you own it? A day. Why did you take title? Did you take title to hold it? Or did you take title only to facilitate the sale? Now, that's kind of a speculous argument. And in recent years, the IRS has started to soften their position to that, because it's very easy to show that simply owning real estate in an entity is the same as owning it out of the entity. It's just a different way of owning it. So if I owned it that way because of liability or because it eased management, in reality, it was still my piece of real estate. So when I drop the LLC, I'm really not changing the owner. I'm simply putting the individual owners in a different form of ownership. And that's why the IRS is starting to like that a little bit more.
Fascinating stuff. I have to ask you one more question. So, note sales. If you own a note and you sell the note, or I have an instance where a note was given and the note went bad, an auction is coming up, are the proceeds, which would essentially be the par value plus penalties on that note, is there any way to exchange that?
Unfortunately not, because notes are not considered to be real estate.
Got
They're
it.
security instruments on real estate.
Got it.
I can't solve that one, James.
Well,
I've tried.
I have to tell you, this has been an absolutely fascinating conversation. I can go on with you for hours, and I'd love to connect with you offline because I think there's some opportunities between us. Before I let you go, you're a big dog guy.
I am a big dog guy. We foster puppies, had them all my life. They're the best worthless animal you'll ever own.
They are. I'm a dog guy myself, and there's just something special about rescue dogs. And I saw that you were a foster dad, if you will.
Exactly.
I said, I'm going to like this guy, even if he is a Tom Brady fan. I'm going to give him a shot.
Oh, gosh. Yeah, but, we both share the Manning name.
Yeah.
You got Eli. We had Peyton in Denver, so
yeah, you had Peyton.
Give me some slack.
So, look, guys, I hope this was as eye-opening and valuable for you as it was for me. Dave Foster, founder of the 1031 Investor, clearly, as far as I'm concerned, the source for these types of transactions. Dave, I can't thank you enough. This was an absolutely, really genuinely value-driven episode. Learned an awful lot today. Really appreciate you.
I had a lot of fun. And I got to tell you, I'm excited now because I was a little worried. If the government decides to get rid of 1031s, I'm calling you to get a job with the dancing girls.
You're going to be my dancing girl, baby. We'll go on tour together. I love it. Dave Foster, everybody. How do we find you, Dave?
Easy enough. Go to the 1031investor.com and everything you need, we got.
All right, PD, let's make sure we put that up on the broadcast when it goes out. Dave, thank you very much. Everyone out there, as always, we appreciate you. Thank you. Keep the comments coming. Keep the likes coming. Keep the questions and suggestions coming. Everybody out there, stay safe.